Hi everyone, in this video I'm going to answer the question, is Target an excellent dividend stock to buy right now? So let's get right into it. Let's look at Target's third quarter earnings results to answer that question. So overall, the spending boom is over at Target. Remember, the company benefited from a sales surge at the onset of the pandemic when competitors were forced to close down and customers had little choice on where to spend their money. Target had benefited from that trend, and now that trend is reversing, and so that boom is over. Overall revenue increased by 3.4% at Target in Q3 to 26.5 billion. Earnings per share fell by 49.5% to $1.54 from $3.04 during the same quarter the year before. Gross margin rate fell to 24.7% compared to 28% due to higher discounts, inventory shrink, which is another word for theft, merchandise and freight costs, which were offset by price increases in other categories. So overall, not very good news for Target in its most recent quarter. Management told investors that this was not going to be a very good quarter, that they were going to need to offer a lot of discounts to get rid of some excess inventory, but this was much worse than expected. The gross profit margin falling 330 basis points was more than expected, and this is still not solving Target's inventory problem, which we'll see a little more down the road. Thankfully, the number of customer transactions or customer traffic was up 1.4% compared to last year. So even though economies are further along in reopening here in 2022 compared to the same time last year, customer traffic was still up at Target. So they're not losing a lot of customers to other types of spending areas. Customers are still going to Target. That was at least a good piece of news for Target investors. To try and alleviate all of these fall and decreases in earnings per share, Target is initiating a cost-cutting effort with the goal of reducing $2 billion to $3 billion in expenses over the next 3 years. And it's lowering its expectations for the fourth quarter and all of 2022. So management already told investors that the rest of 2022 was not looking very bright, and it told investors again that it's worse than we actually told you already. And so, investors were already pessimistic about Target in 2022. Now that's even worse after the third quarter results. And if we look at here, inventory of 17.1 billion was up from 14.9 billion during the same time the year before. So inventory is up about 2.2 billion dollars, which is more than 10%. Some of that increase is due to inflationary pressure, right? They're paying more for the inventory, and so some of that is just due to higher prices, and some of it is due to more units and more inventory. But the bigger problem with Target's inventory is not just the value of the inventory, but also the type of inventory that it has. It has a lot of the type of things that people were buying during the earlier stages of the pandemic, like flat screen TVs, like electronics, which are not as popular right now. Right now, customers are not buying those types of things. They're buying more things that are in favor in the economy right now, like luggage, like makeup. Things like that are more popular because economies are reopening, people are traveling more, people are going out more, going to the office more, so makeup purchases are increasing. But people are not buying as many flat screen TVs because they already bought one during the pandemic, maybe, or in the earlier stages, and they're not going to need another one for several years. The problem is the mismatch in inventory as well as the elevated inventory. So that's not good news for Target stock investors. Finally, Target paid $1.3 billion in dividends in the 9 months ended October 29. That was up from $1.1 billion during the same period the year prior. So a solid increase in Target's dividend payment year over year. However, the trouble is that Target's earnings per share fell by 49.5% in the third quarter, and its earnings per share are going to remain pressured over the next several quarters. And so looking forward, it doesn't appear reasonable to expect Target to increase its dividend robustly, because dividends are paid out of earnings, and you can't pay dividends without having sufficient earnings to back them up. Otherwise, you will run out of your cash balances and you will exhaust your ability to borrow. And so dividends are not sustainable longer term without sufficient earnings. Earnings are pressured for Target, and so for dividend stock investors, Target is a little bit pressured in the near term. So to answer the question I posed at the beginning of this video, is Target an excellent dividend stock to buy right now? I would say no, not right now. Target is not an excellent dividend stock to buy right now. I would I would caution investors in buying Target as a dividend investment right now. Passive income investors would be better served to wait until February, March to get Target's latest results for its holiday quarter, see if it has worked through this inventory problem and how much that has caused its earnings to come down, and what it projects its earnings outlook will be for fiscal year 2023 and beyond. Once we get a bit of more of an update on that and these inventory troubles subside, then I think Target will be a safe dividend stock to buy. But for now, hold off just yet on buying Target stock. All right. So thank you for watching. If you've gained any value from this video, please go ahead and hit the like and subscribe button. It'll help me make more videos like this one. I'll see you next time. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for all investors of all skill sets and risk levels. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com/Parkev to get your 10 stock picks now.